Welcome to this explainer. Today, we're diving into a really fascinating mystery. Why does the credit market absolutely refuse to behave like a normal commodity market? I mean, in a standard economics textbook, prices just adjust to balance supply and demand, right? But in lending, that rule totally breaks down. So we're going to unpack what's known as the credit rationing paradox. It's basically a structural glitch where banks deliberately deny credit to perfectly willing borrowers, even when those borrowers are offering to pay top dollar.
To really get a grip on this, let's just think about a standard, everyday transaction. Say you walk into a grocery store and offer to pay double the asking price for an apple. The grocer's happily going to sell it to you, right? Honestly, they'd probably sell you their entire inventory. So why? If you walk into a bank and say, hey, I'll pay a 30% interest rate on a business loan, will a loan officer suddenly reject you? Why on earth won't they take your money? This is exactly where the standard rules of supply and demand hit a massive brick wall.
The fundamental difference here is what's actually being traded. Normal commodity markets, they trade tangible physical goods right there on the spot. You hand over the cash, you get the apple, boom, the transaction is done. But the credit market doesn't trade physical goods at all. It trades promises of future repayment. And the second you introduce the future into an equation, you introduce uncertainty and risk. Because of this, an interest rate isn't just a simple price tag. It's a massive, flashing signal of risk that changes the entire nature of the deal.
We can trace the core of this whole paradox back to a massive breakthrough in 1981 by economists Stiglitz and Weiss. They essentially proved that interest rates act as a screening device, which triggers something called adverse selection. Think of it like this. If a bank cranks its rates up too high, the safe, reliable borrowers, they drop out. So who stays? Well, mostly high-risk borrowers who, let's be real, probably know they aren't going to pay the money back anyway. By raising rates, lenders accidentally select the worst possible pool of clients. It totally backfires.
And closely linked to that is the concept of moral hazard. Picture a borrower holding a loan with sky-high interest rates. They are under immense pressure, right? This intense pressure actually incentivizes them to abandon safe, steady growth and take wild, speculative gambles with a bank's money. Because, if they go bust, their downside is limited. The bank ends up absorbing that massive loss. So to avoid stepping into this trap, lenders simply cap the interest rate and ration the credit. They just reject applicants outright. Now, this isn't just some abstract academic theory. This invisible market friction creates a staggering real-world impact. We are talking about a $2 trillion financing gap. That is $2 trillion with a T. That's the exact amount of credit that small and medium enterprises in developing economies desperately need to grow but absolutely cannot access, just because banks are rationing credit. And here's the kicker. This credit rationing isn't impacting giant multinational corporations with their audited financials. The real victims here are small and medium enterprises, or SMEs. These businesses account for over 90% of all firms worldwide. They generate the vast majority of jobs, and they drive local economic growth. Yet because they're smaller, maybe a bit less transparent, and usually lack public credit histories, they set off all those alarm bells for adverse selection and moral hazard. Lenders see the uncertainty, and they just close the vault. You can actually see this tragedy of asymmetric information playing out authentically on the streets of the real economy every single day. Picture hardworking entrepreneurs running local logistics hubs, supply shops, or bustling retail spaces. Let's say they want to buy a new delivery van. They know for a fact their business model is safe and profitable, but they literally cannot prove it to some distant loan officer who's strictly using traditional risk formulas. Which brings us to the whole collateral problem. See, traditional banks love immovable assets, like real estate. Why? because you can't exactly pack up a brick-and-mortar building and flee in the middle of the night. But a whopping 78% of a typical SME's capital stock is locked up in movable assets. We're talking machinery, inventory, unpaid invoices. And because outdated legal frameworks just don't protect a bank's claim on, say, a piece of movable machinery, the bank assigns it literally zero value. So the SME has real wealth. It's just the wrong kind of wealth for the traditional banking system.
Section 1. Solving the data problem. Overcoming information asymmetry.
So how do we fix this?
Well, the first major solution is completely rethinking what a credit history actually is. Historically, if you hadn't borrowed money before, you had what's called a thin file. You were essentially a ghost to the financial system. But today, credit reporting services are executing this brilliant three-step process. First, they collect non-traditional alternative data. Second, they integrate the bills you're already paying every single month anyway, like electricity and telecom. And third, by running that continuous payment history through modern algorithms, they take an invisible, thin-file entrepreneur and transform them into a professionally scorable SME. It's a total game changer. And the hard data absolutely proves this works. Just look at the United States. When utility data was finally integrated into consumer credit reports, the acceptance rate for new loans bumped up by 10%. But here is the crazy part. At the exact same time, the default rate dropped by a staggering 29%. Plus, over just a one-year period, 16% of those previously invisible thin-file borrowers opened brand new credit accounts. Lenders aren't flying blind anymore. They finally have real alternative proof of reliable character. And the best part is this authentically scales worldwide. Take Colombia, for example. In 2014, out of 16 million new loans granted, almost 32% went to young people who entered the credit market entirely through the telecommunications sector. Literally just paying a cell phone bill on time became their bridge to formal financial power. It just goes to show that casting a wider net for data totally unlocks the market for a massive block of unbanked yet highly reliable borrowers.
Section 2. Securing the unsecured. Collateral registries and alternatives. Now, generating better data is really only half the battle. We also desperately need the right legal infrastructure. This is where global institutions, like the World Bank Group, are pushing for some vital upgrades, specifically modern collateral registries. If you aren't familiar, a collateral registry is basically a highly secure, public database that records exactly who has a legal claim on a movable asset. By bringing ironclad legal certainty to things like machinery and inventory, banks finally get the confidence they need to just say yes.
But hey, even when traditional bank loans are still being rationed, SMEs are getting super clever. They're bypassing these constraints entirely by turning to alternative financing. Two really great examples here are financial leasing and factoring. With financial leasing, a business doesn't actually borrow money to buy, say, a tractor. They just lease it. The asset itself acts as the perfect collateral because the lessor still owns it. And then there's factoring, another brilliant workaround where the SME just sells their unpaid invoices to a third party at a slight discount to get immediate cash today. Both of these methods brilliantly look at the underlying value of the business operations, bypassing the traditional bank's obsession with real estate completely.
So as the global economy finally evolves to solve this credit rationing paradox by merging alternative data, cloud-based accounting, and modernized legal registries, we are finally bringing transparency to the super opaque world of small business lending. But it leaves us with a really provocative question to think about. As every single utility payment and supply chain invoice becomes globally verifiable, how might these new algorithms and digital registries reshape the future of your own financial identity? It's a fascinating frontier, and the way we prove our trustworthiness is truly changing forever. Thanks for joining us for this explainer.